The housing market seems to be in a state of weirdness. Why do I say that? Well, despite the expectations, home prices across the country have remained stubbornly high. The S&P CoreLogic Case-Shiller National Home Price Index shows that existing home prices have been steadily increasing for the past 7 months. This trend has led to a nearly 6% year-to-date and 2.6% year-over-year increase in average U.S. home prices. These figures are significantly higher than the median increase observed over the past 3 decades. However, a noteworthy development occurred this past October. A crack seemed to have appeared in the market, and surprisingly, it was on the sell side that showed some cracks. We all know the challenge faced by home buyers in regards to high mortgage rates, right? But guess what? It's having an impact on home sellers as well. Despite the limited supply of existing homes, according to the data, during the 4 weeks ending October 29, nearly 7% of homes available for sale had a price reduction, the highest percentage on record. This record-breaking trend coincides with mortgage rates reaching their highest point in 23 years that week, significantly impacting the financial capabilities of potential buyers. To mitigate the burden of high interest rates on monthly payments, some sellers found it necessary to decrease their initial asking price. While sales prices maintained a 3% increase compared to the previous year, this can be misleading, in part because of the nature of sale price data, which tends to lag behind, reflecting transactions that were initiated about 1 or 2 months ago. However, there's a possibility that at the rate of the price growth might decelerate in the coming months, as it begins to mirror transactions that were initiated when mortgage rates reached 8% in October. One of the factors contributing to the rise in sale prices is the persistence of low inventory, which is bolstering prices even in the face of sluggish demand. The overall number of homes available for sale has decreased by 10% compared to the previous year, although new listings have seen a 1% increase compared to a year ago. This uptick in new listings is only the second such increase since July 2022, but it's partly attributed to the significant drop in new listings around the same time last year. The increasing prevalence of price reductions alongside rising prices highlights the peculiar nature of today's housing market. I touched upon this on my recent Bay Area real estate market report, the disconnect between sellers and high price expectations and the financial realities of today's potential buyers. If you are a seller, I want to emphasize that now more than ever, it's crucial for you, the seller, to establish a fair initial pricing to attract buyers and secure a swift sale. Especially because these high 7s, 8% mortgage rate that we have will continue in the near future. Mortgage rates continue to exhibit a general upward trajectory this year, reaching their peak at approximately 8% this October. However, there may be a silver lining in the horizon. In response to a discouraging jobs report that indicated the creation of only 150,000 jobs last month, which was 20,000 less than anticipated, rates briefly decreased to 7.4%. Nevertheless, there are signs that rates are gradually inching back towards the 8% mark. Furthermore, both economists and real estate experts anticipate that mortgage rates will remain at around 8% in the next couple of years. Let me share with you some graphs that I have to what this means visually. Here are the first 2 graphs. These are the affordability index. Basically, what the dotted line means is that a family has enough income to qualify for a median home price. The next one is a visual representation of how much monthly mortgage payments have gone up. From January of 2021 to this August, you can see that it has more than doubled. Here are some graphs that shows historical perspective of mortgage rates. These elevated mortgage rates have compelled certain sellers to reduce their asking price in response to the increased financial burden placed on the buyers as their monthly mortgage payments keeps getting more expensive. I read somewhere that nearly a quarter of new home buyers are now making monthly mortgage payments exceeding $3,000, a figure that surpasses the average monthly income of the typical American, which stands at approximately $4,600. Consequently, this level of payment has become unaffordable for the majority of individuals. The result has been a notable 15% year-over-year decline in existing home sales activity for the month of September. The disconnect that I mentioned earlier stems from the fact that some sellers are still pricing their properties too high because they are most likely looking at previous sales in their neighborhood from maybe 2 years ago or a year ago when properties were getting 10, 15, or 20 or more offers. This low inventory environment that we have is still creating competition amongst home buyers, but really not to the extent that we've seen in the past. A 7.5% to 8% mortgage rate, most home buyers are simply priced out of the market. This was not the case 2 years ago. So there are two things that could happen in order to move the market. One is mortgage rate needs to drop or prices needs to drop. Right now, we all know or being told that high mortgage rates are here to stay, which means prices needs to adjust. But how much will it continue to drop? The consensus in the industry is that home prices are anticipated to decrease until the conclusion of 2023. Moody's Analytics predicts home prices will drop about 4.5% over the next 2 years. In conclusion, the current state of the housing market presents a rather perplexing situation. Despite previous expectation, home prices across the United States have remained or continued to go up, leading to a significant increase in existing home prices over the past year. However, like I mentioned, a crack is starting to appear in the market, particularly on the sell side. Homeowners are starting to reduce their listing prices in response to soaring mortgage rates. This pressure on sellers is not really surprising since high mortgage rates have affected home buyers' ability to pay, hence the necessity to adjust prices. However, again, there's still a major disconnect from the realities of the situation. Sellers are still expecting or hoping for the market of the past, while buyers are looking for a market that is not coming. This has caused existing home sales activity to decline dramatically. And why has prices remained strong and even keeps going up is the persistence of low inventory. Even in the face of low demand, new listings have increased, but this is in part due to a significant drop in listings around the same time last year. So we have right now the increasing prevalence of price reductions along with rising prices, which is the unusual nature of today's housing market. Looking ahead, what are experts saying? Home prices are getting harder and harder to predict. It seems like every quarter the new forecast comes out and it keeps getting revised. Now the latest is that they're saying that home prices will probably decline this year and next year, which is completely the opposite of the last forecast. The way I see it, especially here in the Bay Area, the possibility of home prices going down 5% or more is unlikely. The severe inventory constraint outweighs the demand from buyers that can still afford to buy a home. On a national level, it could be a very different scenario as we are taking a much broader market into account. Now, the mortgage rate side, there's a little bit of more clarity here. At least that's the consensus. And that is that by next year, more and more experts are predicting that we should see rates lower and could even be below the 6% range. Which, by the way, if this happens, we start to see a surge in buyer demand again, and consequently, higher prices. The one thing I do know for sure, real estate is America's choice for the best long-term investment. I leave you with these graphs to help you visualize the effects of home ownership on your net worth.